And we are going to start a bit talking about the Forex market. The fact is that all the idea of the beginner center we developed with FXRate.com team search from the fact that several theories, says that 90% of the traders, the beginners, lost their money in the Forex market, while only 10% of the market succeed, right? The ones that start with trading, only 10% succeed. And the idea was to help that 90% of the people, right, that need to improve their trading from the start. I know that several concepts we are going to talk about today may seem a little too basic, and you may say, oh, I already hear this, I already read this. The fact is that there's a lot of tips and tricks I pretend to teach over the next upcoming sessions and talking about these things, right? So I hope you stay with me. And besides, I want to add just one more thing. This is the beginning of a project, right? I will accept any comment, critique, idea, suggestion, whatever idea you have will be welcome to improve this. Anyway, we are going to talk about the indexes in American Dow theory. You know that all the technical analysis, all what we use these days to analyze charts, all the charts that trace the indicators, it was all based in Charles Dow, right, 1884 theory. He developed two averages for the American indexes, right? The Dow Jones Industrial Average and the Dow Jones Transport Average. And his idea was that with these indexes, he pretended to measure the market as a whole rather than simply focusing on individual stocks, right? Because believe it or not, all that we apply to Forex market comes from a stocks analysis, right? And he wanted to make these two averages the foundation of a comprehensive theory that could be used to explain and predict market movements, because that's what we want, predict market movements, at least be able to predict such movements, right? So he was based on the idea that the economic activity boom responds to a bigger production in industrial companies, right? And these companies enlarge their income, and so the demand of their actions and quotations of them increase too. So this expansion will pull along the rest of the sectors where other companies start to have better income and see their actions also reevaluated, right? But using these indexes, he developed his theory, the base of modern technical analysis and charts. And I want to share with you a couple of very interesting things about these theories, right? The first one, he says that average discount everything. It's what we said when we talk about price discount everything. When we talk about market is pricing in a rate hike in euro, when we talk about market is pricing in a bad payroll number for the United States next week, well, that is that's based on this first of Charles Dow principles, right? He says that the price reflects all market forces that could affect that stocks, right? Like, for example, supply and demand, political factors, market sentiment, and even natural disasters, right? Anyway, besides, on the second principle that I believe is the base of most of his theory, and I have seen this developing in the market several times along the year, right? Price moves in trends, right? We always said trend is your friend, right? That trend is what let us identify patterns, okay? And of course, this trend could be bullish or bearish. While bullish, we call the trends when maximums we have higher highs and higher lows. And of course, the bearish is when both maximums and minimums keep being lower, right? At the same time, this trend could be primary, secondary, and tertiary regarding their duration. In fact, what we call tertiary or secondary trends are just what we in Forex market name as corrections, right, or retracement. Each bullish and bearish market has typical three different stages. And this is something we are close to begin to see in the euro-dollar cross these days, right? I guess we are approaching to the bearish market. But it's a bit too early, right? But we are approaching to that. Keep these principles in mind, okay? And you will see what I was talking about. We said that, of course, the primary bull market, right, is defined as a long sustained price advance by improving business conditions right? That increases speculation and demand of stocks or currencies in our case. And you can see that price actions is always looking for higher levels, right? What we are seeing right now in the euro. While the secondary trend, the retracements, the corrections, is not able to set under the last higher level, meaning when we have a bearish correction, that bearish correction is not able to break below previous highs, right? And that's exactly what's going on with the euro dollar these days. This bullish trend, right, is divided in 3 stages according to Charles Doll. The first one, the one that he calls accumulation, is not easy to separate from the last of the bearish ones, right? They are mostly, but like both are mostly the same. But it's characterized by strong pessimism, right? Where slowly price seems to find a bottom or top and signs up as investors begin to accumulate or establishing positions, right? That accumulation stage is when we see that the volume put in buying the euro increase. We have a second stage called recovery of expansion, right? That we saw that activity starts gains as price begins to rise. It's normally the longest stage of the three and represents obviously a very clear bullish trend as investors start gaining confidence, right? We are super confident in euro these days. The last one is distribution, where a market is fully active. Price runs, volume increases dramatically, and most investors take positions encouraged by greed. This is what is happening today, I do believe that we are in the middle of the distribution stage in the euro, right? It could last 1 day or 1 month or 1 year. Yeah, it could last several of these or any of those. However, there is a way to identify bearish markets or the probable top and reversal, right? I don't see that stage taking place right now. But a bearish market has also 3 stages, and we are now looking for that distribution first stage of the bearish market, right? That's what we need to be paying attention to, right? That distribution stage, as I was saying, is the last stage of the bullish trend, right? Volume remains high, but price recovering starts to come down. That means that despite the price steady at highs, right, it's harder to extend gains. We see a consolidative stage, right, and the retracements, right, despite maybe not the daily candle close below previous high, we see test of that area, okay? So we see that the price is not still able to accelerate higher. The downside, it remains limited, right? But it's harder. We will notice that because one of the things that we are going to talk about that is volume, right? One of the things that will help us distinguish any of these stages will be volume. Anyway, the second stage of the bearish market is called panic, right? We suddenly notice that the selling pressure is much higher than buying one, and the price starts falling and bearish movements start to accelerate. In this stage, it's easy to see some secondary bullish reactions, right? Like the market or the investor trying to hug that slide because, hey, we have too much buy in here. We could not let the price fall. Let's buy a bit more, right? Let's hug this slump. That's the panic stage of the bearish market. Of course, all of this according to Charles Doll. Finally, we have the despair in the bearish market where the sell continues, right? Price is low, but the selling continues. Participants think to sell no matter what. This is what we are seeing right now in dollar, right? Dollar is being sold no matter what these days. And remember what I told you a couple of minutes ago, that the first accumulation stage is pretty similar to the last one, to the despair stage. Yeah, well, that's what's going on right now. We see that the market has, that our friend dollar has lost all charm, right? The fundamental news are bad, the economic outlook bleak, and there are no buyers, right? So the market will continue to decline and until all that bad news are fully priced in the price we see in the chart. Once the currency pair fully reflects the worst possible outcome, the cycle will begin again, and we are going to be in the accumulation stage. I know that this seems a bit more theoretical, right? And we are going to see practical examples over the upcoming session, okay? But I want you all to remember these basic concepts of forex trading that will make your life much more easier. Anyway, and regarding the principles, right? Remember we mentioned too, the third one, right, is the confirmation principle from Charles Goh. He says that in order to confirm a trend, it's necessary that those indices have the same trend, meaning most of the bullish or bearish at the same time, okay? That's what he was thinking of. And here comes what I was trying to tell you about the volume in the forex market, right? When a market is bullish, volume should rise during downside up rallies, okay? Sessions close, right? He did not take into account what happened in the day, at least not his theory, right? He did not care the minimum, the maximum, or the opening, right? He just cares about the close price, right? And finally, of course, trend is valid and it is substituted by the contrary one. Remember, this was developed in 1884. We have seen several times in the forex market that that's not completely true, right? A bullish trend is not followed by the bearish trend. We could see a strong consolidation, lateralization stage in the market that could last again 1 day, 1 month, or 1 year. So, despite it's not 100% true, the fact is that consolidation of the top or bottom of the trend, right, is exactly what we were talking about, the accumulation stage of the first bullish trend, okay? But it happens, right? We not always see one trend after the other, okay? What I want to add right now is that all the technical analysis and the chart system that we use, right, is based on this Charles Goh theory. And you know that today the industrial auction average involves over the 30 bigger companies in the United States, as well known around the world, and even in Europe the Eurozone has created similar ones with the Euro stocks, right? But anyway, let's go a bit further and talk about technical analysis, right? This is a concept that many of you may know, but I want to make something clear. This is a study of past market activity, okay, using graphic tools, okay, in order to predict future movements in the market. Again, study of past market activity, right? We are talking about what happened in the past. That does not guarantee that will be repeated in the future. What this study of the past gives us, right, is a mathematical hope of success in the future. If we know, for example, that every time price opens above a 100 simple moving average in the daily chart for a certain undetermined pair such as pound-dollar, as an example, right? 90% of the time we are going to have a bullish day, right? The mathematical hopes of success are 90%. We have a 10% against us. Nothing is 100% sure in the forex market, okay? But anyway, keep that in mind. We are studying past market activity. Of course, I'm not checking if you have questions or comments. We will do when I finish this with not too much, right? And of course, we all know that it's not only technical analysis what moves the market. We have fundamental analysis and we have several other factors that we are going to talk about over the classes, okay? Anyway, that's the concept of technical analysis. On the other hand, we call chart or analysis or chart system, right, the study of certain patterns developed in graphics, right? The patterns of the candles, the higher highs, the higher lows, things as formations of head and shoulders, double roof, double floors, triple roof, trend lines, right? All the groups of candles or patterns that the price action generates, right? that represent the behavior of the market, right? And we know that after that certain behavior, right, there's a good chance of something in particular going to happen, right? So that's what allows us the repetition of the systems used for forecasting future markets and their objectives. Okay. Again, we are studying past market activity. Okay. Anyway, and to make a small resume of what we talk, all the factors that affect an underlying currency pair, right, is reflected and discounted by the price. Okay. Expectations moving trends, and the quotations movements always repeat themselves. Those are the three basic principles of the Dow theory. Okay. Anyway, I would like to share something a bit more practical right now. Okay, because you know that several of us, many of us, use Fibonacci retracement to talk a bit about where the corrective movements of that contrarian or secondary trends could reach. And we tend to use the 38.2, the 50%, and the 61.8% retracement, right? As the numbers where we know the corrective movements could, the price could come. Well, you know that Charles Dow was the one to say that that price action or corrective movements, right, usually markets movements, split in third parts, right? Meaning, for example, after a move of 100 pips, the market will tend to correct 1/3, okay, of those 100 pips, meaning a 33%. So take a look at the charts, right? We have 33 and 38, okay, and 62 and 66. 61.8 is the Fibonacci, 66 is what Charles Dow talked about, right? So what I mean in here, what I would like to share with you with this particular graphic, right, is that a corrective movement is not meant to reach the 38%. It could reach any area in between the 33 and the 38%. Based on empirical analysis, I can tell you that when a corrective movement begins, you usually reach exactly that area in the middle of the 33 and the 38.2, around the 35%, right? So if you're going to get into a trend in a corrective movement against the dominant trend, right, you cannot set your target at the 38% unless you have very tight stop loss and sorry, I forgot the word. A trading stop, sorry. I guess you understand what I mean, right? The price action could correct in between the 33 and the 38. That does not mean the price action will do, meaning could do. The same goes for the 50% and for the 62 and the 60. Anyway, just a small tip in the middle. But when it comes to charts, right? What a chart means or what a chart represents. There are different kinds of charts we see in the market. What we are seeing right now is the first one of all line charts, right? And this kind of graphic uses just one piece of information, okay? So in this case that we are taking a look at the euro-dollar daily chart, we are only seeing the closing price of each day in the euro. So all those closing price form a line, dot after dot are joined and form that line that we are seeing. Despite, of course, the clear bullish trend, there's a lot of information we are missing in here, right? There's a lot of things we did not know. So there are other types of charts that may be a bit more interesting. Bar charts is next one, right? And despite the information, again, here it's correct. It's not also as clear as the candlesticks we do present here in general, sorry. In this case, each session is represented with a bar, right? Where the top is the highest price of the day, the bottom is the lower price of the day, the horizontal line at the right, at the right, this one in here, this one in here, this one in here, right, is the session close, opening, right? And the other one is the price opening. This side the opening, okay, and this side the close. This is the close part, okay, this side. In this type of bar chart, the opening, okay, at the left, it's not usually posted. MetaTrader does post the information because it's quite useful, right? But it's mostly optional. That's why at the end we prefer the candlesticks, right? Candlesticks bar. However, what I was saying again about the volume, right? About the volume behavior. When we have this kind of days, okay, these days when the opening and the close are very close to each other and we don't see too much of volume, right? But seeing this particular candle, how strong the upside movement is, how the body of this candle is double body of triple body of previous one, right? That's a good anticipation of an upcoming bullish continuation body. We have corrective movements in the middle, yeah, we do. We need to use stops, yeah. We could be stopped and then the price, yeah, that also could happen. However, there's nothing better than those big candles to us and to read the market volume, okay? Of course, we have exceptions, usually triggered by fundamental data, fundamental reports, rates, payables. Those are the kind of reports that can trigger strong intraday movements that can change the trade. But natural disasters, but not much more. Anyway, Japanese candlesticks are most useful and has many others all over the world. And I guess these days no one owns nothing different than candlestick charts for the Forex market, right? The information we have in here is pretty similar than the one given by the bar chart. We have the opening, the close, the high and the low, but it's a bit more visual, right? We can differentiate very clearly which is a bullish candle and which is bearish one, making things easier at the first glance. And I believe that that's pretty much important. However, and one thing about that first glance, right? We tend to open our eyes in the morning when we start trading, right? And before even washing our teeth, we run to the computer to see our charts, right? And we found out a very bullish movement in the market. Say, I have to buy. So we run to buy to the market. And the fact is that the pair has already rose 200 pips while we were sleeping, or 3,000 pips while we were sleeping, and we are catching the trend at the top, right? And we start losing money faster than we get into the trade. So this first glance impression, right? We need to be objective about those first glances. We need to ignore that, oh, this is bullish, I will buy. Forget about that. Forget about that, because that's the first worst mistake we all made when we trade Forex, right? Get into the market just because of what we see at a first glance, right? Despite with the time, the exercise of watching the charts will be much more easier. The fact is that at the beginning of your trading career, right, you need to spend a lot of hours a day just watching the chart behavior to understand price action. And also understand that different currencies have different behavior, right? And different intraday ranges, and different wide intraday range. There's a lot of things that every currency pair will teach us, okay? Anyway, just to finish a bit with all this, so theoretical part, right? I would like to share with you the different time frames and how to work with different time frames, right? I know that this is just price action with no indicator, but depending on your needs and your capacity of trading, right? Some people do have a life and do have a job besides trading, right? So they have no time to be sitting in front of the chart 8 or 10 hours a day, right? So depending on several of those factors, we will analyze charts of short, medium, and long term, okay? Till now, we have been using, as example, daily charts, okay? And the most common accepted one. However, for a short-term analysis, we can work even with 15 minutes. Honestly, I found out that 15 minutes is not as reliable as I wish, okay? As smaller the time frame, the less reliable is the signal we read on it. Okay. However, we can use 30 minutes. Okay, that's the lowest chart I tend to use. Honestly, as the years gone by, my charts have been increasing with their time frame, right? Anyway, and for a long-term analysis, we can study daily, weekly, monthly charts, right? That give us a different perspective in time. The fact is that to trade such a long term, I'm convinced that trading in the month or the weekly charts, at least that's the personal opinion, of course, and you can be against it, but I believe that trading in the shorter term, not in the 1 minute or 15-minute charts, but trading intraday, right, and grabbing a certain number of pips and protecting, of course, your capital will be mostly the same profit at the end than trading and that holding a position for a month, right, for 1,000 pips. You can do those 1,000 pips holding the position for a couple of months or trading intraday all day and getting 50 pips a day, for example, okay? So I'm not sure how much is worth long-term trading, mostly in the Forex market where the volume is so big and the liquidity is so important that, of course, we have to always counterpart to trade with. Anyway, as I was saying, the long-term, weekly, monthly, daily. But I would like to teach you the small trick that I do believe is the best way to trade. Either if I'm going to trade in the 30-minute charts or in the 1-hour charts, right, I will take a look at the 4-hour one, okay? And try to set in the 4-hour one the dominant trend, the supports and resistance levels, all the technical studies that I need for my trading, right? When I'm set in the 4-hour chart, I will then move to the 1 hour or 30 minutes, okay, to look at the signals, okay, that support that trend. I don't say that you cannot profit against the trend. You can profit against the trend. But the fact is that when you try to profit against the trend, your profits will be probably half the ones you get if you trade following that trend, okay? So base all your technical analysis in a bigger time frame than the one that you're going to trade. If you're going to trade a 4-hour chart, then take a look at the daily chart, okay? If you're going to take a look at the weekly chart, if you are going to be a very long-term trader and you're going to trade a daily, well, take a look at the weekly, the monthly. Always move one chart higher, okay? And set the trend, the dominant trend in that one, okay? Now, I was talking yesterday with a couple of guys about what we have been seeing in the hours in the late 130s, right? Buying on dips has been a very interesting trade, as every retracement in the cross has ended to be a higher high, right? So what will you be doing at this point in the price near 49? What will you be doing? Start selling in case we have a reversal, or continue the policy of buying on dips? Of course, one dip at the end will be the last one, right? And we will probably get stopped from that last dip in the price action. However, how many gains do we had in the last couple of months buying on dips in the cross? We need to think about that before entering against the dominant trend, okay?